It's been a rough year for Canadian economy with this uncertainty over trade. Of course, the worst of the damage was avoided, although big levies remain on steel, autos, lumber, parts of the auto industry and lumber. Our guest is cautiously optimistic that 2026 will see signs of improvement, but she says, or her analysis indicates that the economy will grow more slowly this year than last year. Let's get more from Dawn Desjardins, chief economist at Deloitte Canada. Dawn, great to see you. Start off, if you would, with your GDP forecast for this year, because you do see a slowdown in 2026 versus last year.
Hi, yes, we do. We have a growth at about 1.5%, so a shade slower than in 2025 when it was 1.7. That's our estimate as well. I think what I'd say is that we think the first half will be slow. We're going to continue to operate under these extraordinarily uncertain conditions, but we do see reasons that we will see a strengthening in economic activity as we exit 2026 and head into 2027.
What are the brighter signs here?
Well, I think there's a few things. One is that although we're heading into the throes of it, we will have our review of the Canada-US-Mexico trade agreement. Now, our baseline assumption is that we maintain our carve-outs for our exports to go relatively tariff-free south of the border. We still maintain in the forecast some of these heavy tariffs we're seeing on those industries you mentioned earlier. So that takes a little bit of shine off that. But we think that as we go through the review, while the deal might not look exactly as it does today, it will in large part allow us access to our largest trading partner. Additionally, we do think that interest rates will remain relatively low. We have the policy rate holding at 2.25% throughout the course of this year. And I guess when we think about all of the policies that governments across this country are trying to put into place, we think by and large we will see enough on that side of the equation that it will restore business confidence and that businesses will start to put some money to work.
Politicians love cutting ribbons and talking about infrastructure spending, and that's the real core of the government's economic policy right now. They haven't gone for big tax cuts, as you know. Do you think they're on the right track?
Well, certainly when we think about what will instigate some investment by Canadian businesses. Sure, taxes, a big issue. But when we look at other things that are impeding their investment activity, we're seeing lots of red tape, as you say. So the elimination, or at least a significant reduction in some of those measures, I think will go some distance to helping businesses say, okay, we can get a return on our investment on a relatively good time. The other thing, as we know, is infrastructure. We need it. We need it to be improved so that our companies can get their goods to other markets outside of the U.S. timely and less costly.
Do you think there's a problem, though, that international business is going to be wary of Canada because of the trade threat? And also, I don't know if it's at the back of people's minds, President Trump's insulting remarks about Canadian sovereignty.
Well, I think if we're setting the stage to see investment and we start to see Canadian companies invest, that is going to show the world that we are ready to build, we're ready to improve our productivity because we're willing to put our own money into our economy. And I think over time, and remember, none of this is going to happen quickly. We know that for sure. But if we start to see those pieces moving towards investment coming from Canadian companies, I do think that those opportunities will be seen by international investors as well. Again, we're not anticipating any huge, very rapid increase in investment. We do think it's going to take time. So as we exit this year and look to 2027, if we see some concrete improvement in some of these measures, that should, we think, be a catalyst for investment activity.
What about the labour market? Do you see much prospect, well, particularly for younger people who've had such trouble finding work?
Yeah, I mean, certainly when we're looking at the labor market right now, it is pretty soft. Companies are saying, sure, I may not be looking to reduce my workforce because we know population growth is slowing. We know that immigration is coming down significantly. But by the same token, not necessarily looking to add. So what's going to take to get them to really look at adding to the workforce? It will, in fact, I think, be this improvement in confidence, this sense that, yes, we're going to have access to the U.S. market. It's not going to be tariffed, and we will see demand for our goods continuing. So again, it's sort of a longer game. We're looking at the economy sort of in two halves, if you will. The first half is probably going to feel not that wonderful, but as we get through the review of the agreement, as we get to see some concrete results from government initiatives, we think these are the things that are going to turn sentiment, and we should start to see an improvement in the labor market conditions. But again, it's a bit of a time factor here.
Dawn, thank you very much indeed. Dawn Desjardins, Chief Economist at Deloitte Canada.